I think the biggest risk, what's changed, is around labor, and that's a global statement. What's happened since COVID is we've really seen a lack of people come back into the workforce, and it's been probably most pronounced in the U.S., but even countries like China, which have a massive population, their population actually shrank in 2022. So that has huge implications for not only society, but also for companies and ultimately how those companies are valued.
What is kind of the long-term outcome here if this trajectory continues?
I think ultimately what it will mean, if you have more people on the sidelines, less people in the labor force, is you probably will have more government subsidies for those people that are out of work. But there are actually a lot of success stories around labor. If you look, a lot of countries, particularly in Europe, I'd cite Denmark, they're doing a lot more on worker retraining. That hasn't really taken place in the United States, and so there's a huge mismatch. The U.S. right now spends about 1/6 of what Germany does and about 1/20th of what a country like Denmark does on labor. So to me, ultimately, when you look over history, the best economies, the best societies are when labor is engaged working and they're bringing home pay and they feel good about their job. What happened after COVID, let's use the U.S. as an example. 2021, you should have had 166 million Americans in the workforce. We had 162 million. So let's take a step back and say what happened there. Point one is a lot of people that were 55 and older just stepped to the sidelines and said, okay, that's enough. My house went up in value. My stocks went up in value. I'm gonna take my ball and leave. And so that they've started to go into retirement early. The second is there's been a real slowdown in immigration, not surprisingly, given some of the issues around COVID and rising geopolitical tensions. And then the third that I mentioned was really around the fast-moving nature of the economy, where technology has created greater job obsolescence.
But how much of this is a structural problem even beyond COVID?
When you look at labor force, what is GDP? GDP is labor force growth times productivity. So you got to have those two things. In the 2000s, U.S. labor force growth was 1.2%. Today, it's less than half of that. That's a huge drop-off. And so if you only have two variables that you can control, labor force growth and productivity, it really puts a massive emphasis on productivity. And what happens is when you have a workforce, right now we're having job changing actually faster than we've seen ever, that actually leads to lower productivity. Or people decide they're going to be in the workforce, they're not going to be in the workforce, that dents your productivity. And if that's underperforming and then your labor force growth is slower than expected, you end up with slower GDP.
So why is this, the next big risk? Dry out in 10 years, if this trajectory kind of continues, this problem is not fixed, what does the world look like?
Ultimately, it's a slower growth world. It is a world where you have less corporate profits. It's a world where you have more tension, where workers feel disenfranchised, and ultimately that puts more burden on the government, and you probably have more political, I'd say, angst. Those are all huge implications.
Is the idea here that, you're facing a growth cliff in the world because of these labor shortages or distortions? Or is the idea here that the larger risk is, a populist uprising around the world?
I think the more immediate risk is when not a populist uprising. I think generally, you are seeing GDP per capita go up around the world. The question is we've been living in a world where for investors, who watch your show, we've been living in a world where corporate profits have exceeded GDP. We could enter a phase where corporate profits lag GDP if companies don't figure out how to address this labor issue.
What is the outcome here? A labor shortage leading to more unemployment? Is that part of the outcome? The
Fed has raised rates as fast as they ever have and to pretty high levels, and we're now at a 3.5% unemployment rate. That's an unbelievable statistic. The Fed has two mandates, right? One is around growth and the other one is around inflation. If labor is a huge inflationary force, that means you have to have more restrictive monetary policy. So we've been talking about some of the offensive things to do for companies. From a macro standpoint, this is a huge issue. This puts central bankers back on their heels. They're raising rates as fast as they can, and they see unemployment rates going down, right? Think about the Fed. Financial conditions actually eased despite the fact that they've raised rates as much as they have.
So how do you kind of consolidate the big conundrum for central bankers then?
I think they're in a tough spot. I think ultimately what they're trying to use housing, which is a cyclical industry, and a blunt instrument in the form of raising short rates, and that calms the cyclical part of the economy and the goods part of the economy. But back to what we said earlier, it doesn't fix the services part. And so what's happening right now is the Fed's actually hitting its mandate on goods inflation, but it's missing badly on services.
And, I think we're seeing this to some extent, too, both in terms of the wages and both in terms of kind of the dynamic you've pointed out here, which is you can have a job, but you can't pay for your house.
Yeah.
Is that part of
And so there's a dichotomy. What are we rooting for as investors? Right now we're rooting for that inflation comes down and real wages actually go back positive so that employees can buy more groceries, they can pay more for education, they can do things for their households that they want to. That actually hasn't happened despite the fact that wages have been growing 5 to 6%. That's at the household level. The second is that'll enable companies to have greater visibility on what they're paying their employees and hopefully extend the duration of the employees. Right now, the switching costs are huge for employers because people are changing jobs at a record clip. And then finally, the third point is the central banks. The central banks, I honestly believe they think they're at a normalized level, but they're not seeing that show up in the labor data. We need to end up in a spot where we have rates up a little bit higher, real wages are positive, and then you have some visibility around that both the Federal Reserve and the government feel good about. But I think this is it's one of the reasons I think this is the big tension, which is this is not going away.
We talked about a few different places in the world now. If you kind of think about kind of the labor distortion issue, where are the areas that are most pronounced, and where are some areas that are probably winning and therefore could potentially, it sounds like, drive more investment?
What did we have the last 20 years? We were going towards globalization, and it was easy to move from your centers to India or to China. Now what's happening is that's coming under pressure for geopolitical reasons and also, to the point here, for labor. So I think if you ended up in a world where Asia could actually create more domestic consumption, which is I think where we're going, that would put them in an advantage. When we think about our footprint globally, we've taken our balance sheet for 10% Asia to 20%. We want to have that be 25. So, we believe in that. If you had to say, what's the 30-second elevator pitch on why we're having this issue? Demographics, COVID, and ultimately geopolitics. And that is leading to a workforce right now that's subscale relative to what we need. And it's happening at a time of rapid technological change around the world.